Rahul Chadda is ready, Senior Portfolio Manager with the Mirae Asset Management. He joins us live from Hong Kong. Rahul, fantastic to have you back on ET Now. Thank you for joining us. Rahul, depending on whom you are asking, I guess you will get a different answer on how one should read into the FOMC meeting. But the bottom line here is that the era of easy money seems to be coming to an end.
Yeah, I think you're right when you make the statement that era of easy money and huge leveraging is coming to an end, which is why we'll see the correction. First, again, both debt and equity markets would correct. But as investors get confidence that we've got a slow recovery coming in equities, a part of this money would again come back to equities. So again, our base view is that first you'll see correction because there was a lot of excesses because of this easy money being built in the economy. And after these excesses, as the dust settles down, people would look at the medium-term stories and then accordingly position themselves in the sectors, in the countries which look attractive from 3 to 4 years perspective.
Rahul, what happens then in a case where India is involved? Because we're looking pretty vulnerable ourselves. The macro picture is looking bleak at this point in time. You're seeing the rupee which is getting hammered, all thanks to the dollar strength as well. Do you think flows after this knee-jerk reaction that we're currently seeing are going to return back to emerging markets, especially like India?
Okay. For India, I think the critical thing is the trade deficit, something which we maintained for the last 12 to 15 months. RBI's rate action is going to be contingent on what we see on the trade deficit. The last thing a central bank can afford is a currency crisis. So if we see this trade deficit, which it should with the slowing economy, go to a manageable number of $12 to $13 billion a month from a $18 to $20 billion, which we've seen for the last 2 months, I think currency markets would stabilize. And with inflation also coming down, the outlook for India is a lot more better than other economies in the region. Let's understand China is going through its own set of pans where the readjustment is happening in the economy. Commodities are out of the bull market. So clearly the macro indicators are good for India. What we need is trade deficit to stabilize, government to do the necessary things so that people get confidence on the growth in the Indian economy. And I think investors would then take a longer term view on the economy.
Rahul, I'm with you when you say that on a relative basis, India clearly is the cleanest shirt in the basket of dirty laundry. But the big reason why emerging market equities have done well is because US economy was slowing down, US economy was in pain. But now that everyone is optimistic that US economy will revive or has revived, will that challenge the basic thesis for emerging markets?
I do not really think so. See, again, it's really a question of who is better in this ugly contest. Each of the countries, each of the region has its own set of issues. Despite so much talk on US, what we are looking is only between a 2.2 to 2.5% GDP growth number for US for this year. And that number has been downgraded from 3%. So if you look at the US first quarter GDP data also, you've had sequester having its own impact on the GDP. So again, and valuations there aren't really cheap. So as people realize that 2% GDP is what 2.5% GDP is what one gets in US, and emerging markets look attractive. Again, the governments in emerging markets are not letting this crisis go away, is doing the much necessary reforms. At the end of the day, it would all come back to demographics, longer term story. I think there are enough people in the world who are willing to take a three-year view on the markets. There is enough money which is on sidelines, which will take the dips to enter the market. So if one has more than 1 year time horizon, I'm not that bearish, honestly, and would use any significant dips to add to the stocks we like.
So what is it that you like when it comes to Indian equities, Rahul?
I think we've been overweight exporters for some time, some of which is pharmaceutical names have worked, some of which IT has been impacted because of this immigration bill. Outside that, we like private banks, but again, in the near term, they may be under pressure because of, again, slowing in the economy. But if you take a 3-year view, that something looks attractive. Consumer discretionary is the other space we like. We believe that as rate cuts happen in the economy over the next 12 to 15 months, we should see demand revival happening in the economy. And finally, telecom is one sector we've liked for some time because we believe competition is clearly ebbing over there. We can see improvement in the EBITDA per minute for most of these companies, and the sector is going to re-rate in line with the regional peers.
Rahul, historically we've seen that equity markets and currency market, they always move in a synchronized manner. Rupee has plunged to a fresh low against the dollar, and the fact that US economy has recovered will only strengthen the case for a stronger dollar. So do you think in the near term we could be staring at a weak rupee, and if that is the case, the upside could be getting capped?
I think market remains fairly range bound in the near term. Again, like the way we said, from a 3-year, India is an attractive story because we are more at the trough rather than some of our regional ASEAN economy, which are more at a near term peak in terms of GDP earnings momentum. Which is why the downside would not be more than, let's say, 5 to 7%. The upside would be capped more largely in form of election uncertainty because people want clarity on the government. The government's acting, but it's a bit of a coming too late in the day for things to have an impact. Had they done this 2 years back, we could have seen corporates responding with investment in the economy. Right now, I think all these measures happen, but we'll yet to see a follow through from the corporates because everybody's scared of the election uncertainty. So I think we get a momentum pick up in India post elections, which is why markets would be sideways till elections. Outside that, again, I think rupee clearly has depreciated a bit more vis-a-vis the regional pairs, and that's largely on account of trade account. With the slowing economy, our belief is that this trade account should get corrected over next 3 to 6 months, and we should be pretty much in this range for rupee in this.
Rahul, what do you make of the recent bout of selling by foreign investors? For the first time in many months, we are staring at the data where foreigners, not only they've stopped buying, they've started selling. Does the recent pullout in equities bother you?
Not really. See, for the kind of inflows we've got over the last 15 to 18 months, we were first very surprised by the nature of the inflows we got. So what has gone out is just a drop in the ocean. So I think clearly what one needs to see is the follow-up response from the government. Clearly, with this movement of rupee, things should get a lot more easier for governments to push through the necessary reforms. We're positive on what we've seen on the oil price reforms. We need more of FDI to come into the country. See, we can get a 6 to 7% GDP growth rate only when the FDI goes to a $40 to $50 billion. Else, every time we'll hit a 6% GDP, we'll have a trade deficit staring at us. So clearly, we need government to kickstart investment in the economy, get more longer-term investment from a structural re-rating. And then only markets would sustain at high valuations.